So, you've signed a letter of intent. You've got a buyer. You negotiated the price and the terms, and you're ready to get going. You got a deal. The hard part is over. It's not over. The hard part is just about to begin because that buyer is going to tear your business up. This is part 4 of our series on the 6 essential elements of selling a business. Due diligence. This is where the buyer dives deep, looking for any problem, any discrepancy with what you have given or told him, and any reason to try and renegotiate the letter of intent, terms, and price. And if things don't line up, that's exactly what's going to happen. In almost every case, the price will go down. You're not going to be able to improve your position from this point on. The question is, can you preserve it? So part 1, we talked about planning and preparation, which is critical to what we're about to discuss. In part 2, we talked about listing and marketing, also critical to what we're about to discuss. Part 3 was the LOI. We don't need to spend any more time on that. But this is part 4. And how well this goes, how well this due diligence process goes, is going to determine how close your eventual deal is going to look like it is outlined in the LOI, or if it even makes it to closing. So every buyer, even a mom and pop buyer, is going to do some level of due diligence before acquiring a business. The only question is in how thorough and how invasive that process is going to be from the seller's standpoint. From the buyer's perspective, due diligence has one goal: to confirm that buying this business still makes sense. That confirmation only comes from understanding every meaningful aspect, every nook and cranny of the business, the good, the bad, and the ugly. And make no mistake, when you sell a business, everything essentially will come to light. The good, the bad, and particularly the ugly. Things sellers often consider minor or mundane can loom very large in the mind of a buyer who's about to write a 6 or 7-figure check. So what is due diligence? Well, due diligence is the buyer's process of answering this question. Is this business what we thought it was when we made that offer? They're trying to get comfortable with writing a check which in many cases represents their life savings and their family's future. When we represent sellers, which is the majority of our business, we go through due diligence and we prepare them for what's coming. But we still get a litany of questions from, why do they need that? Why are they asking that again? We already gave them that. But from the buyer's perspective, they're taking on risk. They're assuming, inheriting liabilities from you. They're stepping into your shoes. They're investing their family's future, their family's financial well-being. Put yourself in their position. They're going to dig deep, real deep. But imagine yourself on the buyer's side. If you were about to invest hundreds of thousands or even millions of dollars on a business, how thoroughly would you investigate it? How deep would you be digging? I think the question answers itself. The LOI is the deal the buyer will close on if everything checks out. But everything rarely checks out simply because what was explained in part 1 and parts 2 of this series were not followed to the T. So, let's talk about what buyers look for. We've broken this down into 6 or 7 different categories. Number 1, the big one, financials. They want to confirm everything. This is where their focus is on primarily. They want to know that the revenue is real. They want to know that the expenses are accurate, that the earnings are sustainable, Remember, they're buying future earnings. They're not buying past earnings, and they're paying for the fact that the future earnings are not going to be worse than the past earnings. They want to know that the cash flow is as it's presented. To figure all this out, they're going to review profit and loss statements for at least 3 and maybe as long as 5 years. They'll review tax returns in that same time period. They're going to look at balance sheets, several of them over the course of that same time period, to see what changes have occurred and ask questions about that. They're going to look at bank statements. They're going to look at the general ledger. In many cases, they're going to want to see invoices. And they're going to reconcile all of this data. And if your numbers don't match up or can't be clearly explained very easily, you've got a problem. And when you have a problem in this business, it's generally solved, if at all, by a lower price. Number 2, quality of earnings. This goes to recasting. If you watched our earlier videos, you know that if you want the best price for your business, you have to know what that business really makes. It's discretionary earnings. The answer to every financial buyer's question, what will this business put in my pocket? They'll question every owner add back. They'll question every one-time and extraordinary expense that you've got in there. They'll look at all claims for personal expenses that are run through the business. If those add backs aren't credible or they're extravagant and they're not well documented, they'll get stripped out. And that stripping out strips out value and lowers the price. Number 3, contracts and leases. They want to get, you can be sure that every material contract, every material document is going to be reviewed. Buyers want to understand customer contracts. What is the company contracted to do for customers? They'll look for vendor contracts, which are, what are the vendors supposed to do for the company, and what does the company pay them? They're going to look at equipment leases. They'll look at real estate leases. They're looking for specific things. They're looking for expiration dates. For example, if you have a real estate lease for the space that you're working out of, and it expires in 18 months, that's a huge killer for the deal. A buyer wants to know that they're going to be able to stay put for 5 years or 8 years, whenever it is. They're going to look for expiration dates. They're going to look for pricing terms. Do the terms look attractive? Are they reasonable by industry standards? Does the buyer maybe think he can get better terms? Or will the terms change? Which brings me to change of control clauses. Change of control clauses can be deal killers. Buyers look very carefully at these things because a change of control clause can alter the terms of any agreement or even terminate an agreement that the company currently enjoys. And it's triggered, of course, when the business is sold, a change of control. They're looking also for escalation clauses. So that lease that we talked about for the real estate, if that has got a pop every year, what are those pops? Is it easily to calculate? Is it a CPI number? Is it a percentage of sales? What goes up? Nothing goes down. What goes up when a business is sold? A change of control clause can kill a deal quicker than anything else. If such a clause exists in any of the agreements you have, disclose it in the first tranche of documents that you provide to the buyer. Get it on the table immediately. Get it out of the way. You can correct many of these things. You can renegotiate with those vendors or landlords. You can renegotiate so that it doesn't hurt the sale of the business and doesn't hurt the business. Such disclosure might result in a slightly lower price. but it will do wonders for your credibility, and it will give you the chance and the buyer a chance to find common ground with the other party that's part of this, part of the lease or part of the contract. Number 4, employees and management. Buyers are going to ask, who runs this business day to day? Who are the key employees? Do any of them have any special certifications that the business absolutely needs to deliver its products and services? How are these employees paid? How are all the employees paid? What are their pay ranges? How long have they been with the company? What is the likelihood of them staying with the company? If your business depends on one or two individuals, or even worse, you, that becomes a concern, and a concern becomes a lower price. It's the only way to address a concern. Number 5, inventory and assets. Does the inventory actually exist? You state that there's $500,000 worth of inventory. Is it really $500,000? Is it obsolete? Now, you may know that most of your inventory turns 4 to 6 times a year. But you also may know that somewhere in the back of your warehouse there is a whole section of inventory, none of which has sold for 3 years. That is obsolete. Get rid of it. You don't need it. It's not going to sell. It has no value. And it simply will confuse a buyer and cause more concern. Get rid of it. Is the inventory overstated? Again, do you know what you have in inventory? Inventory is frequently a source of post-closing disputes if it's not handled properly during the due diligence period. Now, we posted a video recently on exactly how to handle inventory when selling a business, and you can find the link to that video in the description below. What about FF&E, furniture, fixtures, and equipment? What's its condition? Do you know that there's a need for a new section of your product line, of your manufacturing line in the next 12 months? And that need is going to require a $100,000 investment? It's critical to disclose this. It's critical for them to understand it, for you to make sure that they can believe you when you tell them anything else. The condition of the equipment is number 1. Is the condition or is the equipment superfluous? For example, if your business is 25 or 30 years old and you have a collection of, say, 20 fax machines that were in different departments in a couple of different buildings 20 years ago that are now serving as doorstops when the windows are open, you don't need those fax machines. They're not worth anything. They are superfluous. Get rid of them. Get them off the balance sheet. Condition and age of vehicles. If you've got a delivery business and you say you've got 20 trucks, 20 trucks are shown on the balance sheet, each of them with a cost of $100,000. And you've got them depreciated if your balance sheet is correct. But if 4 of them are up on blocks out behind the warehouse and being used for parts, you don't have 20 trucks. You've got 16. Make sure that your documentation shows that. It's got to be correct. If your balance sheet says one thing and reality says another, expect a price drop. And you can also expect a further loss of credibility. Number 6, legal and compliance. Now, compliance in any jurisdiction, provincial in Canada, the states in the U.S., there are regulations and compliance issues. Make sure that your business is in compliance with all of that. Licenses and permits. Does your business have the necessary licenses and permits to deliver the product or service that you've been delivering? And are those licenses and permits current? What about tax compliance? Are you in compliance with all the tax laws? Are all the filings current? Every year there's got to be a refiling of most businesses in the United States and in Canada. And it is just a simple $50 or $70 fee. But if you're not current, you're not in good standing. Make sure your filings are all current. Regulatory issues. Do you see something that may become a regulatory issue? Something that does to do with water sourcing, waste disposal, anything of that nature? Make sure that your regulatory position is clean and clear. Pending litigation. This is a big one. If you know of or even suspect a lawsuit might be coming, disclose it up front. Failing to do so is guaranteed to kill the deal once it's discovered. A buyer will lose all confidence in what you've told them, and everything you subsequently tell them will become suspect. It's lights out for a deal when a litigation issue arises, particularly one that you knew about. Unresolved legal issues can result in lower value, but they can be negotiated. It could stop a deal, but with the open minds of a couple of reasonable people, a solution to an unresolved legal issue, if disclosed, can be found. An undisclosed legal issue shatters trust, and that will stop a deal cold. Who owns the business? Is there more than one owner? Are there multiple owners? Who has the authority to sell it? Who has the authority to sign and commit the business to a particular position or a particular act? Are all necessary resolutions in place? So even if you are the sole owner, you may have a board of advisors, a board of directors, and that board, someone on that board may have the authority to do X, Y, and Z. Resolutions have got to be understood and in place before you come to market. You don't want to get halfway through due diligence and find out that you need to get someone else's signature to continue this deal. The deal is dead at that point. The buyer won't believe anything else that you say. Next up, taxes, and this is the last one. Taxes, debt, and liabilities. The buyers are going to confirm loans. They'll confirm loan balances and terms with the lenders. They don't care what you tell them. They're going to go to the source. They're going to do the same thing with any lines of credit that your business has. They're going to conduct UCC searches, Uniform Commercial Code searches, to see if there are any liens filed or pending. They'll look for liens that the seller may not even know exist. They'll look for outstanding obligations, miscellaneous obligations. For example, do you owe an employee for back payment on something, or perhaps vacation time that they haven't taken? Do you owe somebody who had lent money to the company, but it's not documented in the company's paperwork, but the lender filed a UCC statement? They're going to look for all sorts of outstanding liens. They're going to look for taxes being paid regularly. They're going to look for evidence going back 3, 4, 5 years that payroll taxes, withholding taxes, sales taxes, property taxes have all been paid. And they're going to want to make sure that those payments are all current. It's important to remember that buyers are not going to take your word for this. They'll verify it independently. These tax issues, some of them can go with the business no matter how it's sold and end up in the buyer's lap. If they are properly represented, they'll know they need to confirm this. So, how does all this process actually work? Well, once an LOI is signed, which I believe you may be at that point now, the buyer submits an initial document request list. This is what they want to see. It might be 50, might be 100 different documents. So you provide those documents within a certain period of time. You're given X number of days to produce those docs. And you will often do so via a data room. Could be a virtual data room, or it could be a hard copy data room perhaps with a law firm or an accounting firm. Some of those firms provide that for their clients. The buyer reviews all of the documents that you provided, and they ask then follow-up questions. Will you respond to those follow-up questions? And then the cycle repeats. There could be 3, 4, or even more document requests in the course of the due diligence. This is one of the reasons why it feels so tedious, so invasive, and in many cases, so frustrating. But throughout the process, remember that the buyer is just trying to justify handing over the family's financial future to you. We've often said throughout these videos and in our blog and in our coaching, we need to make it as easy as possible for the buyer to buy. That is our objective. If we do that, the buyer will have far less reason to doubt what we're saying and far more confidence in what he or she is doing. But now this brings me to a point that we discussed that is related to this, tangentially related to this, but is very important to understand. One of our earlier videos was about the fact that 80% of businesses that first come to market don't sell, and they won't sell until the reason they don't sell has been corrected. Now, the most common reason that a business doesn't sell is that it's overpriced. That's pretty simple. But there are more than a dozen other reasons that businesses don't sell. Some of them are financials don't support the asking price. If you've got $1 million business that you want $5 million for, and the financials just say there's no way, well, there's no way. An asking price is not supported by a valuation. If you haven't gotten your business valued, you don't have any idea what it's worth. Nobody does until a valuation has been done, and the buyer will do that. And you don't want to find out from the buyer that the business, your $5 million business, is worth 2.8. Documentation is incomplete or completely disorganized. We want to make it easy for the buyer to buy. Seller expectations are unrealistic. So what does that mean? Well, for example, I want to close in 30 days, or I'm not going to help with any of the financing. These are unrealistic positions to take. And if those are the positions that you want, the business is not going to sell. The seller becomes frustrated or uncooperative. Now, we've seen this on occasion. It's rare. We've seen them get frustrated. It's a little bit it's a little rarer to see them uncooperative. But it happens. This can really be invasive. We have likened this around our offices to a proctology exam. That is what a due diligence period is, and the patient in this case is the seller. And finally, the buyer loses confidence in the accuracy of the data and or the seller's disclosures. Whatever the seller has said has got to be confirmed. It's got to be true, or the buyer will lose confidence and walk. So how do you best prepare for due diligence? Well, the best way to survive this is to prepare for it before you even come to market. Here's how. Number 1, get your financials clear and clean. Reconcile your financial statements to your tax returns. Eliminate confusing categories or superfluous categories on your P&Ls. Consolidate. Document all add-backs. The balance sheet must reflect reality. Remove outdated and obsolete inventory and equipment. You remove a major source of confusion. Clarity and accuracy build confidence. This is where it starts. Number 2, organize your documentation. Create a structured system for contracts, leases, employee records, corporate records, and financial records. Now, some of these files or folders may have files or folders in them. For example, the financial documents file may have a section for financial statements, another for bank statements, another for invoices. Make sure that you have all of this in order, easily comprehended and organized. If you have to hunt for something meaningful, some meaningful data, or have to explain some confusing records with one or more sentences, or are confined, or you're confronted by a buyer-discovered omission of some material fact, red flags are going to start flying. And when red flags start flying, prices start falling. Number 3, think like a buyer. Ask yourself, if I was buying this business, what would worry me? If I was going to spend $700,000 or $7 million on this business, what would I want to see? What are the questions that I would have that could raise bad or problematic issues? Address this now, not after the buyer discovers it. Number 4, be transparent early. Trying to hide issues is almost always backfiring on a seller. Problems discovered too late or late in diligence lead to price reductions almost universally, or term changes. That's also possible. They lead to deal fatigue. You will get tired of trying to get this deal done, and that leads to a better position and more favorable approach by the buyer. All of a sudden, the leverage shifts to them. It could also lead, these problems discovered late in diligence can also lead to deal termination. Disclose early. We talked about this with the legal issues. Control the narrative. Remember, make it easy for the buyer to buy. And finally, stay professional. The due diligence process can be frustrating, especially so if you're not thoroughly prepared to begin with and the buyer is discovering rather than confirming. Remember, our objective is to make the due diligence period one of confirmation, not one of discovery. Reacting emotionally will damage or even kill a deal. Remember that the buyer is just trying to protect themselves and their family. Now, there's a connection to all of this to our LOI, or in this case, your LOI. Everything we discussed in the last video about the LOI, as well as the preparation and marketing videos in this series, comes into play here. The LOI presented by the buyer essentially states, this is the deal we plan to close on if everything checks out. What this means is that the buyer will most likely stick to the price and terms of the LOI unless they discover something that was not disclosed or is different from what was disclosed. While a strong LOI helps you here, the more important element is the marketing materials you developed to describe and market your business. That's the data on which the buyer based their offer and drafted their LOI. So the bottom line here is that you want the due diligence process to be one of confirmation rather than one of discovery. In order to achieve that goal, steps 1 and 2, preparation and marketing, must be thorough and answer every conceivable question that you can imagine a buyer could have. This is where most sellers reduce the chances of getting the highest possible value for their business. By not having answered all of the possible buyer questions, the due diligence period becomes one of discovery, during which the buyer discovers this issue or that problem. Every item that is discovered is ammunition for renegotiating the price and terms contained in the letter of intent. And the price, I'm sorry to say, only goes down. If you're prepared properly, due diligence is an exercise in confirmation during which the buyer confirms everything that's been disclosed. When that's the case, nothing gets discovered, and the terms of the LOI are likely to closely resemble the final terms and conditions in the ultimate acquisition agreement. your deal will look an awful lot like the LOI. In our next video, part 5 of our 6 essential elements of selling a business, we talk about deal structure, how to set up the different aspects of the deal. Is it going to be cash or will there be financing? If there's financing, is it SBA? Is it third party? How is it structured? Is it going to be a stock sale or an asset sale? And a stock sale or asset sale can be a little confusing. A stock sale can relate to businesses that aren't stock corporations. For example, if you are a stock corporation and set up as a C Corp, for instance, there is stock, 100 shares or 1,000 shares. But if you're set up as a LLC, a limited liability company, there are no shares, but there are units, membership units. So really, instead of stock sale versus asset sale, we should refer to an equity sale or an asset sale. But we'll talk about the difference of the two, between the two, and the fact why you want one, but why the buyer wants the other. What about risk allocation? If you're planning 3 days after the closing to hop on a 53-foot sailboat and head for the South Pacific for 3 years, you want to know what kind of risks are going to be following you. Well, for that matter, even if you're going to be sitting on the porch nursing a good bourbon, you're going to want to know what kind of risks are going to be following you. Risk allocation. And finally, we want to show how to maximize what you actually take home. This is pretty critical, as I'm sure you will agree. Deal structure is critical because the structure of the deal often matters more than the price of the deal. So subscribe so you don't miss the rest of this series. If you found this video to be helpful, hit that like button and remember to subscribe. Finally, thanks for watching. I'll see you in the next video.